My client just bought a 4-unit in Atlanta as her primary residence. We negotiated $40,000 in seller credits. That was $40,000 that covered every single closing cost on this deal, and it fully funded a 2-1 buy down, which dropped her interest rate to a 4.6 in the first year. She's living in 1 unit, and the other 3 are bringing in rental income. To top it off, the seller basically paid for the financing structure that made all of this work. This is what it looks like when you have when you understand how to actually structure a deal and when you have the right team behind you. Let me break this entire thing down. What is going on, guys? Welcome back to another deal of the week. If you are new here, my name is Ricardo Carrillo. I run RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US get financing for both residential and commercial real estate. Whether you're buying your first home or whether you're scaling your real estate portfolio, we've done it all, and my team and I will walk you through the entire process from A to Z. The whole point of these videos is for me to show you the real deals with the real numbers about our real clients and exactly what it is that they are doing to structure these deals so that you can understand what is actually possible when you're doing real estate investing the right way. This is hands down one of my favorite deals that we have closed all year, and I want to spend some time on it because there's 3 separate strategies that are all stacked right on top of the other in one single transaction, and any one of them on their own would be worth talking about, but together they are a masterclass on real estate structuring. So let's just jump right into it. The property was a 4-unit that we purchased in Atlanta, Georgia. Now, my client was purchasing this as her primary residence. The loan amount was $935,000. We ended up doing conventional financing, and it was a 30-year fixed. Here's the first strategy of what we used. We wanted to do a house hack on a 4-unit. By far, one of my favorite plays that I've done personally. I've talked about it for years, because when you buy a 2 to 4 unit property as your primary residence, you're getting the best of both worlds. You get to get the better interest rates and the lower down payments as a owner-occupied property, which is more flexible on underwriting, and you get the rental income from the other units. On a 4-unit, that means 3 of the rental units are offsetting your mortgage payment every single month. Those tenants, they're the ones paying down your loan. 3 streams of income coming into one bank account before you even consider what your actual unit is going to cost you out of your own pocket. Now, for most buyers, the dream is actually just owning a home, and they get the keys and then the cost begins. Mortgage payments, property taxes, homeowners insurance, maintenance on the house, all of them. Now, for my client though, the keys in this case, right, came with 3 rent checks attached to them. Her cost of living significantly dropped the day that she closed. And it's not a small difference. That's the difference actually between treading water and just getting by and having a really high payment and actually starting a wealth building journey. Here's the other piece though that most people miss about a 4-unit. The IRS will let you do this, the lenders allow you to do this, and the whole system is kind of set up to reward these owner occupiers who purchase 2 to 4 unit properties. They're going to give you the same interest rates, they're going to give you the same down payments, and they're going to give you the same access as someone who's buying a single family house, but you're going to get 4 doors instead of just 1. If you aren't at least considering this strategy when you purchase, you're leaving a lot of money on the table. Here's the second strategy. We did a 2-1 buy down. Let me walk you through what that is and what it means and why it actually matters in this market. The note rate on the loan, which is the loan that you get for the interest rate that you get for the actual loan, we got at a 6.6. So that's the contract rate that lives on the loan documents, and you're actually going to have for years 3 through 30. But for the first 2 years, my client is paying a lower interest rate. In the first year, the effective rate is a 4.625. So a 4.6% interest rate, it's 2 full percentage points below the note rate. In year 2, the effective rate goes up by 1%. It goes up to a 5.625, which would be 1% below what we locked the rate at originally. And then years 3 through 30, she would go back to paying the full note rate of a 6.6. That's exactly how a 2-1 buy down works. They're 2% below in year 1, 1% below in year 2, and then it kind of goes back to being what it would normally be. So the dollar impact is pretty real because at a 6.6, you're paying $5,900. At a 4.6, she's paying $4,800. That is a $1,200 savings in the first year alone per month. In year 2, she's saving $600 a month. The total savings is about $22,000 in just the first 2 years. Now, this is where most buyers get confused, so I want to actually explain how this is set up. A 2-1 buy down is paid for with what's called buy down funds. Those funds are brought and collected at closing, and then they're held in a separate account by the bank who holds your loan. Now, each month for the first 2 years, that servicer is going to pull the difference of the payment from that account to make up the difference between what our client's actually paying and what the note payment requires. So the lender is basically being paid in full at the note rate every single month. The borrower is basically just getting a subsidized payment for those first 2 years using the buy down funds. So where do the buy down funds come from? Well, most of the time, the seller pays them. Sometimes it's lender paid, sometimes it's also buyer paid. And that brings up the strategy, that kind of brings this whole strategy together on why I really liked this deal. So strategy number 3, $40,000 in seller credits. This is the part that took this deal from a smart move to a masterpiece. We negotiated those $40,000 in seller credits before we even got into contract on the property, and every single one of those dollars, one of those $40,000, we went to work. We used that money somewhere, and that was because we wanted to cover all the closing costs: title fees, escrow fees, prepaids, any recording fees, bank fees, all of it, $0 out of pocket for our client on closing. And that same $40K fully funded the 2-1 buy down. So if we remember, $22K was used for the buy down, $20K for closing costs. And every month for the next 2 years, that servicer, the bank servicer, is going to pull from those funds, and they're going to cover the rest of the payment. So she's not paying a single dollar to basically set this up. Let me just reiterate so you have an idea of how all of this is set up. Our client purchased a 4-unit in Atlanta. She's living in 1 unit. 3 tenants are paying for the rent. Her first year interest rate is a 4.6. She paid $0 in closing costs. The cost to set up the buy down was also 0 for her. Her down payment, the only money that was actually brought into this deal. The seller basically paid for everything else. And he did it willingly because his property had been sitting and he wanted out, right? They wanted to get this property sold. That's what happens when we negotiate heavily. And this is what I mean when sellers are really negotiating in today's economy. The market has really shifted. A lot of sellers are kind of in a tight position. They need to get rid of properties, and properties are just sitting longer. Sellers, they just want to close. And the buyers who understand how to ask for the right concessions in the way are walking out of closing the deals that look kind of impossible on paper. Now, the thing is that most buyers don't actually ask. They just submit a clean offer and hope for the best. They never bring up seller credits because they think that it's going to offend the seller, or they don't even know what it is. And that's a mistake, because then you're just not working with the right team who's helping you structure the right deal. You ask for the credits to cover closing costs, and you ask for the credits to cover a buy down. You ask for the credits to handle any repairs that you saw on the inspections. You ask. So in this market, more often than not, the right seller is going to agree. Why? Because they want to get this deal done and they want to close. And every time that they say no, that means that there's less money coming into their pocket. So this client asked, right? I told her, I was like, let's structure this where we can negotiate some credits. So we did that. The result was $40K coming in and actually working with her. Now let's talk about why the whole financing picture here actually is important beyond the dollars. Cash flow flexibility. With 3 rentals, offsetting her payments, and a buy down that lowered it for the first 2 years, she's actually not even going to be coming in with any money out of pocket to cover her mortgage. Her mortgage is going to be covered by the tenants in the very first year. So she's basically living for free the first year, able to just save as much money as she can. And then in the future, she could refinance. If rates drop in the next 18 to 24 months, this 2-1 buy down basically gave her that breathing room that she was needing in order to wait for a window to not really feel pressured about needing to refinance, and was able to actually take on those lower payments. The built-in rental income and a 4-unit primary residence, it's one of the best ways to scale your real estate portfolio and one of the best ways to grow real wealth, because you get to have someone who's covering your payments and then you get to live there for free. She's paying significantly less than what she was actually paying even in her rent. And once she's lived there for the required period, she could even move out and then turn it into a full 4-unit. You only have to live in the property for 1 full year, and then you could technically, you can move out and rent out all 4 units. That is the game. You buy 1 new multifamily every single year. This is exactly what I love about the work that I do. It's the deal structuring. We get to be a part of these deals where my clients are winning in real time, not just on paper and not in theory, they're actually doing it and they're taking action. Lower payments, more income, less out of pocket, more options. That is exactly what financing is supposed to do for you when it's structured right. So if you're looking for your first home, your first multifamily, trying to figure out where do I even go? What do I need to do? How do I win in this market without having to bring 20, 30% down? This is the kind of structure you should know exists. Go to rclending.co or find me on my Instagram at Richie the Lender. My team and I work with buyers just like this all over the country, and we can walk you through the entire option and what is available to you and how we can do this in your market. I appreciate you guys for watching. If you haven't seen my other Deal of the Week videos, you can click either here or here. I appreciate you guys. Thank you for watching. Make sure you like and subscribe to the video. I will see you guys in the next Deal of the Week.